All right, our topic for the lecture today is the causes of the Great Depression. We're not going to talk about the whole thing, but we're going to talk a little bit about how we got into the Great Depression. Okay. Those of you with a little more background knowledge in the time period might know, when we look back and we say, okay, the start of the Great Depression, what do most people point to?
Stock market failure.
The stock market crash, okay? And so I think a lot of times we point to that and we go, oh, the stock market crash, that's what caused the Great Depression. Okay? And that's not the whole picture. We have to understand that there's a lot more going on, but the stock market's a piece of it. Okay? So our first topic, our first cause is the stock market. That played a role. Okay? During the 1920s, the price of stocks had really shot up. During the 1920s, the price of stocks had skyrocketed, really. People were making lots of money off of buying stocks. And it makes sense, right? If you buy stock at, say, $25, and then the price goes up to $50, and you sell that stock, you just doubled your investment, right? It's a great way to make some money. So in the 20s, you know, not everybody, but everybody who's buying stock, for the most part, is making money. And so they're like, great, let me buy more stock. Prices are just skyrocketing. In October of 1929, people started selling off their stock. Prices started going down, so people said, okay, I'm going to go ahead and sell. Right? Now, if people start selling off their stocks in large numbers, what's going to happen to the prices? They're going to continue to go down, right? So buying and selling stock, that happens every day, right? Some people buy, some people sell, right? But in October of 1929, the prices start to dip down, and the problem was panic set in. Panic set in, and people said, I need to sell now so I can make as much money as possible. And so what ends up happening is the span of about 1 week in October of 1929, there's a mad rush to sell stocks. And so as more people are rushing to sell stocks, the prices are dropping even further, which leads more people to rush to sell their stocks, and prices are dropping even further. So this wasn't like a gentle decline. And on Black Tuesday, it's the nickname it gets, Black Tuesday, the stock market crashed. It took a nosedive. By the end of 1929, right, and this is like late October, we're almost actually to the day today, it's October 29th, today's the 25th, we're almost at the 90th anniversary of Black Tuesday. By the end of 1929, so in just over 2 months, the stock market had dropped in in value, dropped $30 billion.
So that means that the total people lost $30 million?
Yeah, the total value of the stock market had plummeted by $30 billion. And you can see it on the chart, right? I mean, right, that from right there to right there, that's the end of 1929, right? It is a nosedive, a free fall, whatever term you want to use.
But where did that money go?
Right? The money is put into the stocks. The stocks are worth a certain amount. And when those stocks lower in value, that money's just gone, right? It's an investment. It's a risk. So people they're taking a risk when they invest in the stock market, right? And if that stock drops in value, you're just out that money, right? And so in a minute, we'll talk about kind of why. So one way to kind of think about it is that the stock market, as it was shooting up, an analogy that historians will often use is sort of like the stock market was like a house of cards, right? You can build it pretty tall, but it doesn't have a very strong foundation. And all it takes is just a little nudge and the whole thing's going to come crumbling down. And that's exactly what happened, right? It had been built up, the prices were overvalued. They were selling for more than they were worth. And so when people start getting jittery, right, that you get that stock market crash. And I think the simple thing to do would say the stock market crash caused the Great Depression, the end, moving on, right? But that's too simple of a picture. There's a lot more going on here, okay? And we already know from the video and just from having some background here, you know, some people lost everything in the stock market. There's stories of stockbrokers literally jumping out of windows in New York City because they had lost everything. And here's this guy with this killer car going, I've lost everything. I'll give you this car for $100. All right, so our second big cause, and these two things are closely related, the stock market and the banking crisis. But I want to talk about the banking crisis in a couple terms here, buying on margin and the runs on the banks. Throughout the 1920s, when the economy was doing really well, banks were very willing to loan money to people. Makes sense, right? The economy's doing well, people can pay the loans back, let's make lots of loans. However, by the end of the 1920s, banks were starting to make loans that were riskier and riskier. Individuals, just average people who wanted to get into the stock market because they saw, stock market is doing awesome, people are making money. They would go to banks in the 1920s and they would do something called buying on margin. And I want you to know what the term means. Basically, what that would mean is that people would buy stock with a down payment out of their own money, and then borrow a whole bunch more money from the bank in order to buy more stock. Okay? I'll say that again, right? They would put a down payment on stock out of their own money, but then borrow a lot of money to buy more stock. Just as an example, right? I might go to a bank and say, listen, I want to buy $10,000 worth of stock. Stocks are doing great. I want to buy $10,000. I don't have $10,000, but I have $1,000. So what I'd like to do is I would like to make a down payment of $1,000, and then I'd like you to loan me the other $9,000. But don't worry, the stock market's doing great. We're going to make that money back in no time, and I'll pay you back that $9,000 plus interest. It's going to be great. Win-win for both of us. And banks are willing to do it because the economy's going great. Okay? Now, what do you think happened when the stock market crashed?
The bank said they want to.
People could no longer pay the banks back. Okay? So when that stock market crashed, people weren't able to pay back their loans.
So the banks have like, if you want to take out like a loan for a house or make payments on a house, the bank takes the house as like collateral, so if you don't pay it back, they just take it.
Okay, that's a good point, right? And so a good example of this idea of buying on margin today is like a mortgage, right? Like when Miss Carmichael and I bought our house, we didn't have the money to pay for the whole thing, right? We had to take a loan from a bank called a mortgage loan. So we put a down payment down out of our money, and then the bank covered the rest of it, and now over a set period of time, we pay back the bank. Now, what they call the collateral on that is the value of the house. So if we stop making our house payments, what will the bank do?
Take it.
They're going to take our house. If I'm buying stock on margin, what's the collateral?
Stock.
The stock.
Yeah, so it's not determined.
And the stock has just dropped into the basement. So the collateral isn't worth the balance of the loan, right? So you can see why for a bank to go, I'll give you a loan for a house, the house is going to be worth something. I'll give you loans for stock, and then the stock goes, pfft, right? You just default on your loan, and the bank's out of luck, okay? So people can't pay off their loans, and this scares the bejesus out of everyone, and it leads to, across the country, runs on the banks, right? Banks start closing, and it scares people. They go, wait a minute, I put my money into these banks, I want my money back. And so Americans would literally line up around the block to get their money out of the bank.
Were any of them successful doing that?
Very few, right? The people in the front of the line might get their money back, but eventually the bank's out of money and they just close their doors. So if you're in the back of that line, what happened to your life savings that you put into this bank? Remember the story we saw in the documentary we watched? The guy said, I spent decades saving up $1,000 and I had it safe in the bank, and then the depression happened and it was just gone. The bank shut down. Right? And there's no safety net. The government wasn't involved, and so there was no safety net underneath. The money's just gone. Okay? So thousands of banks end up closing across America. Right? And Americans really lose faith in the financial system. With no parachute there, no safety net, Americans really lose faith in the banks, they lose faith in the financial system. All right, another cause of the Depression that's connected to this is the idea of overproduction and underconsumption. We know from the last couple of chapters we've been working through that in the 1920s, factories using the assembly line were making more goods than ever before, right? American factories are making more goods than ever before. Farms were producing lots of crops for market. Right? We know farmers were struggling in the 1920s, but not every farmer. Right? Some of them were able to take out loans and get new equipment and improve the productivity of their farms. So there's lots of products, there's lots of goods, there's lots of farm produce. The problem was that we overproduced. By the end of the 1920s, factories and farms were producing more products than Americans were able to buy. By the end of the 1920s, 40% of Americans were living in poverty. By the end of the 1920s, 40% of Americans were in poverty. So more and more Americans were going into debt to buy the things they needed. If you don't have the money, you might have to borrow the money, right? So there's a lot of people in poverty. More and more Americans are going into debt by the end of the 1920s. Which means fewer and fewer people are buying products, okay? So these are like basically two sides of the same coin, right? On one side, you've got the overconsumption. The companies and the farms are making more products than people are able to buy. And on the flip of that, people are struggling to have enough money to buy products, right? So those two things are related to one another. Now, put those two parts together. If companies are making too many products and people aren't buying them, what might they have? Bless you. What might they have to do to their workforce? They might have to fire some people. So they downsize, right? They lay people off. Well, if you lay people off, what can those people not do? Work, make money. What can't they spend that money on? Buying new products. And so we're still struggling to sell our products. We have to fire more people. Now there's even fewer people to buy our products, right? And so that you get stuck in this sort of vicious cycle of layoffs leading to people not being able to buy products. Eventually businesses just have to shut down. Right? So lots of companies, like again, we saw in the documentary, I had my grocery store, I put my whole life in my grocery store, but people couldn't buy the products, and eventually I just had to shut down.
Wait, so because I know like, Ford automobiles are still around today, like assuming that company not shut down?
Sure, so I mean, not every company dies. It's not like we went extinct business-wise and then rose from the ashes, right? Some companies survive, right? But there's an awful lot, especially small businesses, that just they aren't able to survive. They aren't able to sell their products. They can't turn around and go to the bank and ask for loans, because what's happening to the banks? They're shutting down, right? And we'll see in just a second, the government inadvertently makes it worse too. Okay. All right, so between the assembly line and the farms, there's more products than we can buy, and at the same time, people aren't making enough money to buy things, so we have overproduction and underconsumption. All right, the fourth cause we're going to talk about is government action. The government ends up making things worse. And two topics we'll talk about: the Federal Reserve and the tariffs. Okay, so the Federal Reserve, perhaps it's maybe not necessarily the most full picture I could give you, but a simplified idea of what the Federal Reserve is sort of like a bank for banks, right? And as the Great Depression starts, you don't like that noise? As the Great Depression starts, the Federal Reserve took an action, and I'm not well versed enough in economics to explain exactly why they took this action, other than to say they thought that it perhaps would help. They lowered what's called the discount rate. The Federal Reserve lowered the discount rate, which made it harder for banks to get money from the Federal Reserve. I'll say that again because that was kind of a lot. The Federal Reserve lowered the discount rate, which made it harder for banks to get money from the Federal Reserve. What that did was it tightened the supply of money in the country. It meant that there was less money circulating throughout the economy. So it's just really bad timing to do that, right? At a time where banks really needed more money so they could survive, we needed more money in the economy, the government actually takes us in the wrong direction and tightens the money supply. There's less money in the economy, right? So when Roosevelt takes over, he's going to change that, right? He's going to start pumping money into the economy with the New Deal. So as I said, right, I mean, if banks aren't able to get money, they can't loan money to businesses. The businesses need that money to stay, to stay afloat. They can't get it. They have to fire people. They have to shut down. Okay, so these things they're kind of interconnected. All right, the second and last thing I want to talk about here is the government decided to pass tariffs. Congress passed tariffs. Right there. Tariffs are a tax on goods coming from another country. Congress passed tariffs, which are taxes on goods from other countries. Now that was supposed to help U.S. businesses, right? The idea was, we'll help U.S. businesses. We want people buying U.S. products here in America, so if we make products from other countries more expensive, people will buy stuff made here in America. That will help American businesses. It's another example of really bad timing, though, right? Because instead of helping, what it does is this leads to a trade war with European countries. We wind up in a trade war because if we put tariffs on products from their country, what do you think they're going to do? They're going to put tariffs on products from America. Right? We see that happening right now with China, right? Our government's putting tariffs on Chinese goods. China's turning around putting tariffs on American goods. And there's real concerns about us getting into a long trade war with China. And that's exactly what was happening with Europe under President Hoover, right? We tax their goods, they tax our goods. That really backfires because, hey, we've got all these businesses who have made more products than they can sell here in America. So where do you think they're going to try to sell them? Europe. And guess what? They're not buying them because we're in this trade war. Right? So bad timing, it backfires as well. Companies aren't able to sell their goods, they have to fire more workers. Eventually they might have to go out of business, right? So you see, all these things are just connected. It's not as simple as saying the stock market crashed and so the Great Depression started. There's a lot more happening that all sort of coalesces right around the end of 1920, the start of 1930. It's ultimately going to doom Herbert Hoover's presidency, right? He gets absolutely annihilated when he runs for re-election, and it brings Franklin Roosevelt in, and Roosevelt ushers in this New Deal, which we'll talk about a little bit later. Okay.